I think a lot of this, what Jeremy Stein first started and then Coach Lakota was discussing recently, I think these are early days. I think they're right. They're going to generate a bubble, and we are misdirecting the stimulus. The stimulus was meant to go to households, and we still have a lot of households that are funding their mortgages at 5 or 6%. It's not getting there. In Europe, the Germans are funding two-year government debt at negative yields, while the Slovenians and many others are funding them at 5 or 6. You're not distributing this stimulus very evenly, and I think that's an important problem with monetary policy, and it's what creates bubbles. We've done it before, we'll do it again. So I'm not worried about it yet. I am worried about it for the long run because, in general, the way we solve one bubble popping is to usually end up creating another bubble to mask the negative impacts from that previous bubble.
You're talking about a transmission problem, right?
Yeah, we've discussed this in the past, the household transmission or the peripheral.
But the Fed doesn't really have any options, does it?
Well, I disagree with that. I think the Fed did have a lot of options. It did a lot of transmission fixes when the transmission mechanism didn't work in 08 and 09. It created the TALF, the TAF, the PDCF, the AMLF, the blah, 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 FF.
Have been repaired.
Right. The only one they didn't create was something for residential mortgages, which, by the way, was a pretty big one.
Let's talk about the opportunities. Yeah. As long as the Fed is in the game and gives no indication that it's bailing anytime soon, do you have to be a buyer of treasuries and of U.S. equities?
I think you have to bet that short-term interest rates are going to stay low for probably longer than even the forwards are projecting. So yes, in that sense, in the front end. I think where you run into the problem is in the long end, and it's complicated. When we've seen QE1 and QE2 happen, when people get excited about it working, they start to sell off the long end of the market on the expectation that it's going to work and the Fed's going to have to reverse it. I think it's very hard to get excited about owning 10-year notes or 30-year notes for a long-term horizon. But if you're a trader and you're kind of good at getting in and out, well, yeah, you can probably front-run the Fed for a little while.
What would you rather own right now, S&P 500 or the Nikkei?
The Nikkei. Absolutely. The Nikkei is, in my opinion, where all the action is. Right now, Japan has changed the game. They are on a mission. This is a guy who 12 years ago wanted a 3% inflation target. And he's finally got the job. Kuroda's in. Abe wants him. It's the most advertised and probably a very subscribed trade. But I'll tell you, the other thing about the trade that's interesting, a lot of people are putting the trade on in the yen. Mm-hmm. And Sarah, I know you're the FX girl here. But the yen is a very politically charged instrument. And in order to reflate the economy, they can actually probably use the portfolio balance channel domestically to drive people into equities and real estate domestically without involving the foreign exchange sector. And I think a lot of people are stuck in the FX world, and it might be not the best way to express the trade.